I'd like to review 5 different decade returns because I can't tell you how many times people call me up and they tell me, listen, for 10 years, 10 long years, this investment did better than that investment. And that has to be an indication of what's coming. Surely 10 years must forecast the future return, maybe the next 10 years. And I hear so many people tell me, Mark, I only have 10 years. I only want to look at the last 10 years. Well, that is completely wrong, completely misleading, as hopefully you will understand here in the next few minutes. So in the last 10 years, from January 1, 2010 to December 31, 2019, this is the layout, both the return and the volatility or standard deviation of those returns over this 10-year annualized, an annualized return over this 10-year period. And what do you see here? Well, we put a crosshairs on the S&P 500 because that's kind of a common benchmark or a common index for most people to refer to. And one thing that's very clear is that should not be some benchmark. It's just one of many indexes. Any one of these could be your benchmark, but instead, the combination of these that you choose ends up being your benchmark going forward. As I said in a recent video, if you have a 50% NASDAQ, 50% S&P portfolio, your benchmark is a 50-50 blend of those two indexes. And if you got 11 indexes, it's 11 indexes as they are blended in your portfolio. But here you see that over this period, large growth and NASDAQ were, and maybe small growth to about the same return in this case, were the only ones that had a return better than that common S&P large cap index from here in the US. And in fact, you might notice that those are in squares, meaning that we don't include those in our portfolio. So you can see over this period of time, our investors who have been here for this 10 years feel that they've missed out on getting some of those returns. And in fact, most of the things that we've diversified into actually had lower returns over this period. But now what I want to do is go into a little time machine, and we're going to go back to the period just before this period to see what we saw in the 10 years before this decade. And look at this. This is from 2000 to 2009, the 10 years just before the last 10 years. And look at the complete reversal of the previous chart. Just as a reminder, now we have large growth in NASDAQ on the bottom, back to the last decade. Now large growth in NASDAQ are on the top. Complete reversal. Also, all of these indexes that are a diversifier in our global equity allocation actually did better than large growth NASDAQ and even the large blend of large companies here in the US. And you see actually the highest performing asset index in that period were the emerging market value index. And by the way, you can go to ifabt.com to understand how we construct these indexes. And then you see emerging markets small cap, international small in value, international small real estate, US small value, emerging markets, international value, large value, small cap, and small growth creeped up there a little bit. But you hear a lot of value, a lot of small from 3 geographic regions around the world, US, international, emerging markets. By the way, that's the first 10 years of my experience in this investment business. We started the company in basically November 1999. So it's almost precisely this first 10-year period that we lived. And after 10 years, we were looking like geniuses to a lot of the clients. But what happened after that is the next 10 years from 2010 to 2019, and you see a very different story. So So which one of those actually forecasts the future? Maybe neither one of them. But now I'm going to go back 3 decades. We're now going to go back to the 1990s, which was actually the 10 years that I was looking at when I first started IFA, looking 10 years back, the decade before, right? And so we see something that actually looks more like this decade. Just as a reminder, I'm going to now jump back to 2010 to 2019 and back down here to the decade before the 20 years, 30 years ago now, the beginning of this one anyway. And now you see large growth, NASDAQ above the S&P again. And then you see all these diversifiers down below the line. So this was interesting. When I went to speak to a lot of clients when I first started, if you looked back 10 years, most people would think you were absolutely crazy. Why would you diversify into all those investments that had done worse than that simple S&P 500 index fund? In fact, when I started, that's what most people thought of as indexing. That has evolved a lot since then. But when you saw that, you're going, gee, I don't want to own those kind of portfolios. But yet the long-term data had suggested that was a good idea. And so that's what I was recommending to clients. So I looked like a pretty good hero after the first decade because the decade before didn't look like that. But think about this, how these 3 decades look very different. Now, let's go back even further. We're going to now go to the 1980s. 2 decades before I started. And now you see kind of a similar program where you've got NASDAQ, large growth, and small growth ended up with the lowest returns over that period. And you see that small growth looking really bad down there with huge volatility and really the lowest return, even though that return was still 10% in this period. That's the other thing you got to be a little aware of is the scales here. We were going to try to make all the scales the same, but it got a little complex. Maybe I'll do that at some future date. But you see this scale actually starts at 10. So it's a great decade, no matter what asset class you were in. But on a relative scale anyway, the international small value was probably the best place to be, an international small. And international value, all 3 of those of which we're looking very good in this period back in the 1980s. So if you look at the 80s, it's a little bit like what we think of as the long-term data, where those international small and value tilts have greater risks and therefore should provide greater returns. But this begs the question, is 10 years enough for you to make decisions about how to asset allocate and design your percentage allocations to various investments? And I would assure you that's not the case. So the next time someone tells you, oh, this investment did the best in a 3-month period, your year-to-date returns, my goodness, how silly is that? 5-year returns, silly. 10-year returns, it makes no sense. So how about now we go back to the 70s? And one thing you'll see here when you look at the 70s is that there aren't as many buttons on here. What we've done is we've taken off those asset classes that did not have what I'll call pure data that reflects just that type of index for that period. So we still had NASDAQ then. In fact, I think it started in like 73. So we stitched a little data there. You can again see that in our back-tested performance. But here's another bad decade for large growth, NASDAQ, and small growth. And maybe now after seeing what maybe 3 of the 5 of those where they're down below, you see that why that is not likely to be the long-term winner. I'm going to show you the 50-year data here in just a second. But also you can see here that small value, international value, large value, international small, all those indexes with both small and value in them did really good in the 1970s. But these growth-oriented investments, basically growth, you should think of it for those with some accounting background, is you're buying a lot of goodwill at the time of purchase. The difference between the purchase price and the book value. And the larger that gap is, the more the goodwill, and the lower the returns have been as we look further and further back in time. So now let's take all 5 of those and put them in a 5-decade chart. And maybe now some of you will appreciate why we use almost as a default 50 years of data. And of course, I hear from so many people, don't tell me about 50 years. I don't have 50 years. Well, that's not relevant. If you have 10 years, you can see that looking at the last 10 years didn't tell you anything about the next 10 years. So you have to look at long-term data, lots of samples, lots of dice rolls, lots of coin flips. And the market is like that because of fair prices, so that we can get a better estimate of the whole bell curve, the average, the range of outcomes over large samples. And those set your expectations for the future, or at least they're the best guess of those expectations. But even at that, you can't expect that even in a 10-year period, you're assured of getting the 50-year average. And hence, the difficulty of being a long-term buy and hold investor. You have to really understand all this data to be successful, because those investors who move their assets around based on what happened in the past, even if it's 10 years, are almost destined to failure because the next 10 years is not likely to look like the last. Just as a quick review, I'm going to do this again. Let's start here with the most recent one. Then we're going to do the one before that, then the decade before that, and the decade before that, and the decade before that, and then all 5 decades. Wow, what a story. That hit me one day that we should do those. I've always wanted to do them in 10-year increments with what we call the big chart. We finally got it, put it all together. We're going to there's going to be an article about that as well. But actually now you've got a nice little preview. And that wraps up my 5-decade review, my individual decades review. Be safe out there.